If you can truly grasp the concept of supply and demand, you'll be able to trade alongside major institutions, identify high-risk reward setups, and secure consistent profits. In this video, I'll walk you through powerful insights about institutional supply and demand that most traders overlook. We'll cover what supply and demand really are, how to interpret institutional order flow, a step-by-step method for drawing supply and demand zone, how to locate high probability institutional zones, and how to enter and exit trades to maximize returns. But before we dive into that, you need to understand the real reason price moves. Is it because there are more sellers than buyers? Actually, no. That's a misconception. Stick around to discover what really drives price movement. See you right after the intro. Welcome back, traders. As history shows, traders are emotional by nature. When millions of people participate in this high-stakes game filled with fear, greed, and doubt, their collective behavior often follows predictable patterns, what we call herd mentality. These patterns leave clear traces on the charts, and that's something we can use to our advantage. Every day, countless orders flow into the market from participants with different goals and strategies. This flow of orders generates the price action we see on our charts, which then forms recognizable patterns. And because these patterns repeat over and over again, we can use them to make educated predictions about future price moves. When large financial institutions place their trades, they can't completely conceal their activity. Their presence leaves clues, and if you know how to read the market, you can spot these signals. Currency prices fluctuate due to the ongoing battle between supply and demand created by speculators. For a transaction to occur, there must be a buyer and a seller agreeing on a price. This constant tug of war is what moves the market. Buyers introduce demand, pushing prices upward. Sellers introduce supply, applying downward pressure. Think of the market as a non-stop auction where both sides fight for the best price. Ideally, this should be a balanced, transparent process. But in reality, financial markets are often heavily influenced or even manipulated by major players. Let me explain further. Markets operate as two-sided auctions. On one side, you have bids, buy orders, and on the other, you have offers, sell orders. These are displayed in what's known as the order book. On the left, you'll find the bid side. This shows how much buying interest exists at each price level. On the right, you have the ask side. This shows the selling pressure. The higher the volume at each level, the more liquid the market becomes. Think of the market like an auction, similar to eBay. If you're a buyer, you place bids. If you're a seller, you set the price you want someone to pay your ask price. Now, keep this in mind. A trade only happens when both a buyer and a seller agree on the same price. For every order to go through, it needs a matching counter order of equal size. For example, if someone wants to sell 10 lots, there has to be a buyer ready to purchase all 10 at the seller's asking price, and vice versa. This is how price gets pushed around in the markets. What many traders don't realize is that there are two types of participants on both the buy and sell sides, passive and aggressive. Let's start with the passive traders. So when you see bids and asks stacked up in the order book, those are limit orders, passive in nature. But if all traders were passive, the market wouldn't move at all. That's where aggressive traders come in. So the aggressive traders don't wait, they take action immediately at the current market price. To do that, buyers must cross the spread to buy at the ask price, and sellers must cross the spread to sell at the bid price. On most trading platforms, buying happens on the right. That's the current ask. If you want to buy right now, you have to accept the seller's price. Selling, on the other hand, happens on the left, the current bid. If you're selling instantly, you're accepting the buyer's price. This constant interaction between passive and aggressive orders creates what we call order flow. So what does this look like on a candlestick chart? When you see price rapidly shooting upward, that's aggressive buying in action. The market keeps climbing until it finds enough sellers to meet that demand. Once it's rebalanced, the price settles. On the flip side, when aggressive sellers flood the market, they wipe out the bids, pushing prices down rapidly until their sell orders are filled. This constant battle of supply and demand and the imbalance between them is what causes price to move. The market is in a non-stop search for liquidity 24 hours a day as long as it's open. Now, we're not trading with the same volume as big institutions, not yet. So how do we make sure we're on the right side of those massive moves? That's where supply and demand zones become powerful. But how do we spot these zones, especially when price is just ranging sideways? In such consolidation phases, institutions are accumulating or distributing orders. When price reaches the lower end of the range, buyers tend to step in, seeing the asset as discounted. At the top of the range, sellers see an opportunity to short at a premium. It's the classic buy low, sell high principle in action. Eventually, when aggressive buying overwhelms the available supply, price breaks out of the range to the upside, searching for more liquidity. And this breakout forms what we call a demand zone. We don't jump into trades during the initial breakout. That's usually where emotional traders panic buy at the top, falling victim to FOMO. Instead, we wait for price to return to the breakout zone. That's where we look for our entry confirmation, giving us better risk to reward and putting us in sync with institutional activity. But why does price often revisit these zones before continuing? Simple at the initial breakout, there often isn't enough demand to push price further. When price returns to the demand zone, it's tapping into areas where institutional buy orders were previously placed. Institutions are likely to defend those levels. Plus, it's likely they didn't get all their original orders filled the first time around, so they'll be eager to complete their entries at favorable, discounted prices. There are other explanations as well, but we'll keep things simple in this video. Now, the exact opposite happens with supply zones. During a ranging market, when sellers dominate and cause a strong imbalance, price breaks down sharply. That creates a supply zone. And again, we don't sell the breakdown. Instead, we wait for price to pull back into the supply zone to look for potential short setups. This all happens in a clear 4-step process. The range, price moves sideways, orders build up. The initiation, price breaks out, creating imbalance. The mitigation, price returns to the zone. The continuation, price continues in the direction of the order flow. It's the continuation that we're aiming to trade. That's where institutional order flow is clearly in control. This cycle is the heartbeat of the market. Price continues to move in one direction until an imbalance forces it to reverse and seek liquidity in the opposite direction. Here's an example. Price breaks out sharply to the downside, creating a supply zone likely triggered by institutional selling. It then retraces back into that supply zone, giving us a chance to short. As supply dominates, bearish momentum continues. Eventually, though, the market moves low enough to become attractive again, demand builds, overpowers supply, and a bullish move begins. Institutions will now defend their entry zones on the way up, keeping their positions profitable. The most reliable trades always follow the dominant order flow, and trying to go against it is usually a bad idea. So, how do we draw supply and demand zones with precision the same way every time? There are 3 main types of zones, but the 2 most effective ones are, first, range-based zones. These occur when price consolidates in a sideways range, then breaks out decisively. You draw the zone from the top to the bottom of that range of candles. Second, pivot zones. These form at key turning points in price, usually with 1 or 2 candles. You mark the zone around the candles where price reverses sharply. For supply zones, this is typically a bullish candle followed by a bearish thrust candle that closes below its low, and this is often called a buy to sell zone. For demand zones, you'll see the opposite. Usually a bearish candle followed by a bullish thrust candle that closes above its high, known as a sell to buy zone. Now, personally, I'm not overly strict about the textbook definitions of buy to sell or sell to buy zones. Sometimes I'll mark a demand zone, even if the setup involves 2 bullish candles, as long as the move clearly shows a pivot and a strong breakout. I'm mainly watching for where price paused briefly, then launched in one direction with momentum. That said, there's one important rule. For a valid demand zone, the breakout candle must close above the previous high. For a valid supply zone, the breakout candle must close below the previous low. In some cases, you can refine a large range zone down to a pivot zone or even to a fractal zone, which might just be a wick. The more refined the zone, the tighter your stop loss can be, increasing your potential risk to reward. But here's the trade-off. More refinement increases the chances that price might not reach your entry, leaving you out of the trade. So there's a balance between precision and practicality. Once your zones are defined and your entry rules are in place, the next step is to stick with a consistent approach. Find a method that offers a good balance between getting enough trade setups and maintaining solid risk to reward, and don't constantly change it on a whim. The edge you're developing relies on long-term consistency. A good place to start? Focus on single candle pivot zones. They offer a nice middle ground, not too refined, but still accurate enough to give you tight entries and high reward potential without missing too many trades. Remember, the market is simply the result of countless buy and sell orders being matched. But we make sense of all that complexity using candlestick charts. For example, a range-based zone you see on a 1-hour chart might appear as a pivot zone on a higher time frame. If a range consists of 4 candles on the 1H chart, switching to the 4H will often condense that into a single candle, forming a clear pivot zone. That's the fractal nature of price action, multiple smaller moves making up one larger movement. Once you understand this concept deeply, you'll reach a point where you can mentally visualize how a different time frame would look without even switching charts. So, what makes a supply or demand zone institutional? Not all supply and demand zones are equal. Some are far more likely to produce strong moves, especially those that meet institutional criteria. There are 8 major factors to consider, and here are the first 2. 1. Did the zone cause a break of market structure? This is one of the strongest filters you can use. It takes significant institutional volume to break structure in a high liquidity market. The more meaningful the structure it breaks, the stronger the zone becomes. Swing structure breaks are more important than internal breaks. Internal breaks are more significant than minor fractal ones. So, if a demand zone caused a break of a daily swing high, that's a major signal. When price returns to that zone, there's a high chance that the demand there can push price to break another swing high. 2. Is it a flip zone? This occurs when the control shifts from one side to the other, supply turns into demand, or vice versa. You must clearly see this shift play out. First, supply is in control, causing a move lower. Then, price returns to the supply zone, but this time it fails to make a new low. Instead, strong buying pressure steps in, overpowering sellers. That kind of pattern confirms a flip where supply is turned into demand. And these are often high probability trade setups because you're trading from a level where a clear battle occurred and one side visibly won. These are zones formed when the market grabs liquidity as the zone is being created. Why does this matter? Because institutions need opposing orders to execute their trades with minimal slippage. If they want to buy, they need a large pool of sell orders to absorb. And guess where that exists? Below previous lows, where retail stop losses sit, or where breakout traders are trying to short. Institutions take advantage of this by buying into that sell-side liquidity. So when you see a zone formed right after a liquidity sweep, that's a strong sign of institutional activity. 4. Inducement. This is another liquidity-based concept. And while it can get technical, here's the simple idea. Before a zone is triggered, you want to see available liquidity just before it. Why? Again, it provides institutions the opposing orders they need to enter with low slippage. For example, if there are clear lows just before a demand zone, those sell stops become fuel for institutional buy entries. But if there's no liquidity leading into the zone, then the setup might be a trap and the zone could fail. 6. Higher time frame alignment. When you're aligned with the bigger picture, trades tend to work out better. For instance, a short may look good on the 5-minute chart, but if the 15-minute is showing bullish structure and has just bounced off a demand zone, that short becomes risky. Higher time frames usually dominate, and multi-timeframe analysis helps filter out weak trades, saving you from unnecessary losses. 7. Well-priced zones. The best demand zones are often located in the bottom half of a price range, discounted prices, while quality supply zones are in the upper half, premium prices. This naturally aligns with the core principle of buying low and selling high. It also enhances your risk-to-reward ratio by putting you in trades with more room to run. A mitigated zone is one that's already been touched or traded into, meaning many of the resting orders may have already been filled. A fresh zone, on the other hand, hasn't yet been tested, and therefore, it's more likely to produce a strong price reaction when price returns. Focus on unmitigated zones for the most explosive moves. Now, combining these factors, the more of these confluences you can stack together, the higher your chances of identifying a high probability institutional zone. So, can we enter from these zones? There are many entry styles, but here are 3 reliable methods. 1. Limit order. Simply place a pending order at the zone and let the market fill you. 2. Candle confirmation. Wait for a clear reversal pattern at the zone, works best when combined with a liquidity sweep. 3. Lower time frame break of structure. Drop to a lower time frame and wait for confirmation via a microstructure shift. This offers tighter entries and better risk reward. We'll go deeper into each entry, type in a future video, make sure you're subscribed so you don't miss that. trade management, and keeping it simple. Before even thinking about entries, you should already know where and how you'll exit. Trade management could be a full topic on its own, but here's a simple and effective tip. If you want consistent results, use the fixed ratio method. For example, always aim for a reward of 3R, which means that the profit targeted is bigger 3 times than your risk. This set and forget approach removes emotional decision making and avoids second-guessing technical targets. And remember that trading is a probability game, and sticking with fixed risk reward ratios helps keep the probabilities on your side. Now that you know how to identify high probability zones and the logic behind them, check out the next video in this series to learn more tricks and hacks about supply and demand zones. Thank you for watching, and see you in the next video.